Okay, let's start by looking closely at this virtuous complexity strategy as presented by KMZ. How did they actually build this model?
Okay, so at its core, it leverages random Fourier features, RFFs. Think of RFFs as a sophisticated way to take a small number of original identifiable variables, let's call that K, and mathematically transform them into a very large number of new nonlinear features, P.
K into P.
Right. In the KMZ paper, they took just K equals 15 underlying predictors. Things like those from the widely used Goyle-Welch data set, that's a standard collection of macroeconomic and financial data people use, plus some lagged index returns. Standard stuff, really.
Okay, 15 variables.
But from those 15, they generated a staggering P equals 12,000 RFFs.
Wow. So you take this small handful of original predictors, blast them out into 12,000 new complex features. That sounds like a lot of variables for, well, potentially not many data points. What do you do with them then?
Then this incredibly complex set of RFFs is used in what's called a ridgeless regression to predict excess returns on the stock market. Now, this is crucial. Ridgeless here means there's no explicit shrinkage or regularization applied.
No regularization. With 12,000 predictors, that sounds risky.
It might sound counterintuitive, even risky, exactly, especially when you have far more predictors, P 12,000, than observations in your training data, which could be as low as T 12 months. Normally, in machine learning, if P vastly exceeds T, you'd expect massive overfitting, right?
Right, the model just memorizes the training noise and performs terribly out of sample.
But here's where it really gets surprising. They used rolling training windows as small as T equals 12 months. Just one single year of data. This deeply contradicts conventional wisdom, which, as we said, holds that to extract any useful, persistent predictive signals from financial variables, you need sample sizes spanning decades, not just a single year.
It's like trying to predict a marathon winner based on how they ran in the first, 100 meters. Seems impossible.
Precisely. So the reported stunning result by KMZ was this strong out-of-sample performance for their market timing strategy. On its face, it suggested that heavily over-parametrizing models, where P vastly exceeds T, could somehow lead to excellent out-of-sample predictions. It seemed to radically overturn established thinking in financial modeling.
Okay, so a complex model, minimal data, stunning results. Almost feels too perfect. But as often happens with these groundbreaking claims, someone else comes along to scrutinize the mechanics. What did Stefan Nagel's research uncover about this stunning performance?
Yeah, this is where it gets really, really interesting. Stefan Nagel's research steps in to challenge the whole idea that the RFF-based strategy learns genuine predictive signals. He argues its success is, in fact, more like a coincidence.